Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Later in today's program, I'm joined by Michael Pento, who makes a couple of explosive predictions for the economy, the bond market, and precious metals, and also talks about the market fallout he expects if President Trump fails to push any of his policies through Congress. His comments may surprise you, so don't miss a tremendous interview with Michael Pento coming up after this week's market update. Precious metals markets are pulling back as the Federal Reserve note has been strengthening against other currencies. From a technical perspective, gold and silver were both due to take a breather. Silver had put in gains for 9 weeks in a row, while gold ran into trouble at its 50-week moving average last Friday. This week, gold and silver saw their biggest drops of the year. Checking in with the markets, gold prices are down 2.5% on the week to trade at $1,226 per ounce. Silver is off 3.6% to bring spot prices to $17.77 an ounce as of this Friday morning recording. In our Monday market commentary, sent out to nearly 1 million readers by email and posted to our website, we warned that a pullback was likely to take place soon. If you're not currently receiving email updates from Money Metals, you owe it to yourself to sign up for them on the main page of our moneymetals.com site. It's absolutely free to sign up, and you'll get the latest precious metals news and promotions right in your inbox. Aside from some technical backing and filling, precious metals markets don't appear to have been thrown off course from their impressive start to the year. They could potentially get thrown off by the next Federal Reserve policy meeting, March 14th and 15th, but it's just as likely to serve as a catalyst for the next up leg. Right now, markets are pricing in a near 80% chance of an interest rate hike. Investors seem to be looking forward to the gradual tightening of monetary policy, even as the Trump administration is pushing a highly expansionary fiscal agenda. On Tuesday, President Donald Trump addressed Congress. In addition to calling for tax cuts, Obamacare repeal, and various regulatory reforms geared toward growing the economy, Trump also proposed massive spending increases.
I am sending Congress a budget that rebuilds the military, eliminates the defense sequester, and calls for one of the largest increases in national defense spending in American history. The time has come for a new program of national rebuilding. To launch our national rebuilding, I will be asking Congress to approve legislation that produces a $1 trillion investment in infrastructure.
It's not exactly a path to a balanced budget that President Trump outlined. It's more like a path to asking Congress to raise the debt ceiling once again. In less than 2 weeks from now, the government could run into its statutory debt limit. Unless Congress raises it, the Trump administration could be forced to engage in some of the extraordinary measures the Obama administration used on multiple occasions to avoid a debt default. Former Reagan administration official David Stockman is warning that a fiscal crisis looms following the debt ceiling showdown. He is bracing for potential chaos to ensue in financial markets. The Democrats and the so-called deep state are pushing back hard against Trump's agenda. They seem to be willing to risk another financial crisis if that's what it takes to thwart his plans to make America great again. Trump is learning that the path of least resistance in Washington is maintaining the status quo and satisfying its demands for money. Trimming or reforming entrenched bureaucracy is much easier to propose than to enact. Bottom line is that fiscal restraint appears to be off the table, even with a Republican president and Republican-controlled Congress. More spending and higher debt levels should ultimately put downward pressure on the U.S. dollar, at least in relation to gold, silver, and other hard assets. Investors would be wise to consider the myriad of ways in which they can own hard money outside of the banking system. And on that note, we're always looking for new products we can make available to customers. On Tuesday, Money Metals Exchange announced the release of the half-ounce New Zealand Bounty legal tender silver coin. It's now available at unbeatable low premiums for a fractional size coin. Fractional silver has long been popular with investors seeking to combine the historic status of silver as real money with the ability to barter and make exchanges in smaller increments. Demand for half-ounce silver bullion products is significant, yet few government mints have ever offered them in a legal tender coin form. Those that do tend to command higher premiums due to the relative unavailability of fractional legal tender silver. The bounty coins in the popular half-ounce size are different. This is a Money Metals exclusive due to our unique relationship with the New Zealand Mint. Like the full-ounce version, the half-ouncer features an image of the historic HMS Bounty, a merchant vessel taken over by its own crew in a mutiny in 1789 and later burned. The obverse features the iconic profile of Queen Elizabeth II, making this coin instantly recognizable as official legal tender of the British Empire. Money Metals' premium on this radiant new silver offering is as low as a mere $1.39 per coin over spot, a substantial savings off the premium of any legal tender fractional silver coin you'll find anywhere. You can order the New Zealand Bounty coins or any other bullion products on our secure website, www.moneymetals.com, or you can always call one of our friendly and no-pressure specialists at 1-800-800-1865. Well, now, without further delay, let's get right to this week's exclusive interview. It is my privilege now to welcome in Michael Pento, president and founder of Pento Portfolio Strategies and author of the book, The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. Michael is a money manager who subscribes to the Austrian School of Economics and has been a regular guest on CNBC, Bloomberg, Fox Business News, and also the Money Metals podcast. Michael, it's great to have you on with us again, and thanks so much for joining us today. Welcome back.
Thanks for having me back on, Michael, and great to be on with Money Metals.
Well, the last time we had you on was right after the election back in November, and a lot has happened since then in terms of the Trump administration taking shape. Now, on that front, I want to zero in on the monetary policy side of things here first off. Now, we've been hearing Trump and his Treasury Secretary, Steven Mnuchin, make lots of little comments lately about wanting a weaker dollar. Now, we used to hear U.S. officials talk up a strong dollar, even though we never really believed them. It sounds like you don't believe them this time around either. You've written that at least if you look at the policies they're pursuing, despite saying they want a weaker dollar, they seem more likely to get a stronger dollar, at least versus the other world currencies. Am I understanding you correctly, and why do you think that?
Well, first of all, let's just to be clear. So no fiat currency regime ever wants stronger currency because in the modern Keynesian groupthink, they believe that you grow through exports, and how do you engender exports is by crushing your currency. You grow the stock market, you grow wealth by ruining your currency. Completely antithetical and illogical, but that's what they think. But why do I think the dollar should be strengthening? And by the way, the dollar's up to a 14-year high. I've been long the dollar, and I've been right. The reason why I believe the dollar should strengthen here for a while, for a while longer, is you have a more aggressive Fed. So you look at interest rate differentials. You look at where the U.S. 10-year is. It's at 2.45%. As opposed to Japanese bonds and German bonds and European bonds. There's more value here in the United States, so that's flow into the United States, into the U.S. dollar. You have different monetary policies. The Federal Reserve is on record saying they want 2 or 3 or 4 rate hikes, depending on who you talk to. I even heard 5 this morning from one of the governors. So you have rate hiking mode here in the United States as opposed to the continuation of QE, albeit from 80 billion euros to 60 billion euros in the Eurozone. And of course, Shinzo Abe and Mr. Kuroda in Japan, they're stuck at printing money forever. They can never even hint at stopping because the market would collapse and the economy would collapse. So in addition to that, and to those reasons I just gave you, we just heard this morning from Larry Kudlow, and a friend of mine who's well connected in the White House, that the border tax adjustment is back on the table. So that's the strategy they're going to go with in the Trump White House. They're going to border adjust taxes. So basically it would be domestic revenue minus domestic expenses. It encourages people to sell things overseas and to source things here in the United States. So that would, in theory, lower the trade deficit in the United States, and that should be dollar friendly. At least the trading algorithms are programmed to buy dollars when they hear that. So that's what I see happening for the immediate future. I'm not saying go long the dollar and then go on vacation. What I think is going to happen is that I believe that Mr. Trump, as well-intentioned as he may be, is going to fall into the meat grinder of Congress. He's not going to be able to get through all of his policies. And that, I believe, while that is occurring, the Federal Reserve will slowly, behind the inflation curve, but slowly raise interest rates. And I think what's going to happen in our near future, in the next several quarters, will be a flattening of the yield curve and a recession in the United States. And that is when the dollar is going to absolutely tank.
Isn't all this business about a strong dollar versus a weak dollar a bit of a red herring? I mean, when you look at real things, whether it's real estate, gold, food, whatever, it seems pretty clear that the purchasing power of all currencies has been steadily falling over time, although it does happen at slightly different rates. Why is it that people have seemingly no clue about what's going on with the Federal Reserve note, Michael, and really all of today's world currencies for that matter?
Well, they're not, I guess it's a lack of education. I can't speak why people are so ignorant about what's going on with the Federal Reserve. If you look at the Fed's balance sheet, they control, what do they control? All central banks control base money supply. So that's physical currency and central bank credit. And if you grow that base money supply, you're going to get inflation. If you even look at in Germany, their inflation just was reported this morning, up 2.2% year over year. That was the highest level in 4.5 years. Even in the Eurozone as a whole, 1.8% year over year. In the United States, 2.5% year over year, CPI, Consumer Price Index. So they're getting their inflation. As crazy as it is, these central bankers have pursued inflation targeting fervently, and they're so enamored with their own prowess to engender inflation that they think they can actually engender the exact 2% inflation target and that it will just stop there. And they're completely in for a shock when they come to realize that they cannot hit an inflation target and stick the landing right on the head. So they're going to get 2%. They have achieved that, as I just showed you, and it's going to wax higher and higher. And I believe that's where they have their real problem, because if you have inflation that sits on top of record low interest rates and record high levels of debt, they're going to bring about, global central banks are going to bring about a crisis much greater than what we experienced in 2007.
Getting back to interest rates, we're continuing to hear the Fed talk more about these small hikes. You said, 4, maybe even 5 this year. Do you think they'll follow through on several of these additional rate hikes? And then how do you think the Fed's moves over the next year or so will impact things like precious metals and mining stocks, real estate, and even conventional stocks?
Well, I like to say, what's kryptonite for gold? What's the bane of gold is rising real interest rates. So if you have nominal rates that are rising, and if they are rising higher than the rate of inflation is increasing, how fast inflation is increasing, you're going to get a rise in real interest rates, and that's the depth of gold. Now, I believe this is, like I said, a very truncated situation. You're going to see probably 2, maybe 3 rate hikes, and in that time frame, that'll probably take us sometime around the fall or the end of 2017. At that time, you will going to get resolution to Mr. Trump's policies. If he gets everything through that he wants, perhaps real interest rates will not be rising. But if he cannot, then you'll see real interest rates fall. And when real interest rates fall, the yield curve flattens, break-even spreads start to contract, and that is when you bring about your next recession, and that is when you want to pile into precious metals and go short the U.S. dollar.
We had Jim Rickards on a couple of weeks ago. He talked about how Trump may end up appointing up to 5 of the Fed governors over the next year or so. He's talked about wanting a weaker dollar. Do you think we're looking at a lot of doves on the Federal Reserve Board here before long?
Well, see, Donald Trump campaigned through his whole campaign. Mantra was the Fed is, quote-unquote, doing political. So they weren't raising interest rates because they wanted to elect Hillary Clinton. That's what Janet Yellen was accused of doing. And now that Trump is in office, he's championing this. He said, the stock market's up because they're enamored with Donald Trump, and that he really doesn't want interest rates to go higher, and he really wants a weaker currency. But as I said, all of his policies, if they come to fruition, are dollar positive, stronger growth, trade wars. So there's a conflict. I tell you for myself, I'm very interested in seeing who he appoints, because who he appoints, does he want a rules-based, John Taylor-like appointee to the Federal Reserve? In that case, I know he wants interest rates to go up, and he wants a stronger dollar. If he appoints more people like Janet Yellen, then I would assume that what he says about a stronger dollar and what he does is going to be totally different. Then I will be absolutely assured he wants a weaker currency if he appoints more doves. So I'm very much interested to see who he appoints at the Fed.
Is the bond bubble you've been writing about in the process of bursting, or will the seemingly bad effects of rising rates trigger another rate-cutting campaign, another QE, and another leg up in bond prices?
Well, right now, today the 10-year note is soaring, so today it's working out. The bond bubble is bursting. And yields are up from, I think, 1.37 on the 10-year in July of last year. So we have had a significant increase in nominal interest rates. And the question is this the real bursting of the bond bubble? And I contend we have one more leg down in yields. And again, let me paint this picture again for your audience. I believe the Fed is going to buy into their own mantra that they can raise interest rates with impunity. They do indeed flatten out the yield curve. At that point, we have a recession sometime later in 2017. At that point, we're probably going to go into not only lowering of interest rates, because don't forget, if we have a recession, the yield curve is probably going to flatten out, the 2-10 spread probably flatten out around 2%. And if that's the case, then you only have 200 basis points. If the Fed funds will be almost about, we would say, 1.75, 2%. You only have 200 basis points to remove of accommodation. So they've removed those 200 basis points. That does nothing to relieve the stress of the recession. So they probably return to QE, maybe even helicopter money. And it's at that point when we launch helicopter money, we'll have helicopter money in Japan, Europe, China, and the United States concurrently. At that point, I think you get intractable inflation, and that will surely blow up the bond market. But when I say blow up the bond market, I mean the 10-year yield going back to where it was and even higher than it was in the 1970s. So we're talking about 15 to 20% or higher on the 10-year note. That's what's probably in store for the United States sometime in our near future. And that's what I'm really, really afraid of.
Talking about getting back to a situation where they have to cut back on those rate hikes and reduce rates again. What about negative interest rates? What about the war on cash ramping up again? Where do you think we're headed there?
Well, you hear more and more about the Keynesian elite Illuminati global central planners who want to abolish physical currency. Why do they want to do that? They want to do that so you have no choice but to either keep your money in the bank or to spend it. And if you keep your money in the bank and you can't take cash out of the bank and stuff it in your mattress, it's abolished. Well, what happens then? They, and I mean they by governments and central banks, can make the interest rate as negative as they want and force you to spend money and destroy your savings, the purchasing power of your savings, if they want to. And that's where I think we're headed. Unfortunately, I think that's where we're headed because, as I said, the next recession, because we have record amounts of debt and record low interest rates, those two things cannot exist when they interface with inflation targets. So if you have inflation that's rising and interest rates artificially pushed down to zero and below, at one point we had $14 trillion worth of negative yielding debt, and you have total debt in the world at $230 trillion, which is 300% of global GDP, you're going to have a problem like you've never had before, a worldwide recession/depression. And that's going to be met with unprecedented stimulus from governments. And by stimulus, I mean negative interest rates, negative nominal rates, forget about real, the banning of cash, helicopter money, and massive fiscal intervention. So that's where we're headed. And if you're not watching this and planning for this and have a plan to protect yourself from this, you're going to be in deep trouble. And you can't just have a plan that says, I'm going to own precious metals forever and short the market. See, what I do here at Pento Portfolio Strategies is I model when it's appropriate to overweight precious metals and to go short the market, and when it's appropriate to just to buy the stock market in general. Now, I'll say this, I'll caveat, you should always have, in my opinion, always have 10 to 20% of your money in precious metals and mining shares, always. That level, that minimum level, could be increased to as high as 80 to 90% of your assets once this helicopter money and next depression hits.
Looking at Europe real quick, what are you expecting there later this year? We've got some key votes coming up. So the nationalist parties are gaining some momentum. Do you think the EU is going to last, Michael? And what are you expecting over there across the pond?
Well, you see the ECB balance sheet has increased from about €1 trillion to €4 trillion since Mario Draghi took over. And the reason why he's done this, let's be clear, Europe is an insolvent nation. Look at Greece in 2012. Their 2-year note went to 350%. Let me say it again. The 2-year note yield in Greece, 350%. And that's when their national debt went to 170% of GDP. Well, look, if the ECB was to ever stop their quantitative easing program, what would happen to insolvent Italian banks? And who owns that bank? Who owns all those Italian bank debt? It's the ECB and the member central banks. You're talking about bankruptcy, insolvency all over Europe. And then you have this surge of nationalism, which started with the Brexit, then it moved over here in America with the ascendancy of Donald Trump, and now we have Marine Le Pen in France. So you have this surge of nationalism and this growing tendency towards greater and greater involvement of fiscal and monetary policy that cannot be removed. And that's especially true in Japan and in Europe. So you asked me if I think the Eurozone can exist in its current construct, which is a monetary union without a fiscal union, and I have to say no.
So bottom line here, Michael, as we begin to close, how much longer do you anticipate the euphoria in the stock market and the U.S. economy to continue? And what, in summary, do you see as some of the greatest potential risks and also opportunities that people should be looking out for as we move throughout the year?
Well, the enthusiasm over Donald Trump is surely key to the success in the stock market. You know, if you look at the stock market's valuation, it's absolutely off the charts. So if you look at the total market value of stocks in relation to GDP, it has never been higher than it is today. If you look at other metrics like price to sales or the CAPE ratio or the Q ratio, these metrics prove that the stock market is way over its skis. It's at very, very extreme valuations. And if Donald Trump cannot push through significant, and I don't mean tax reform that's just superficial. I mean cutting the rate from where it is today to 15% and a huge infrastructure package. I mean, he has to push through everything, the repeal and replace of Obamacare. He has to get all these things done, and he has to get it done by the August recess. And if these things don't happen by August, and as I said, I have my doubts, the stock market's going to roll over. Long-term interest rates are going to start to fall. The Fed is going to run smack into a flattening yield curve. You're going to have a recession, and then all hell and chaos is going to break loose on a global scale. So you have to have a money manager that's watching this, that can switch from an inflationary hedge or inflationary bias to a hedge against deflation. We're going to swing wildly between those two things. And if you intend on making money in the good times like we have today and preserving your purchasing power when things switch, you have to be cognizant of these changes.
Well, excellent stuff, Michael. It's always great having you on, and I know you're traveling later today, so we certainly appreciate you making some time and being so generous with that time today. Now, before we let you go on that last point you made there, talk about how people can learn more about your services there, your firm, how they could potentially become a client if they're so inclined, and then also how they can read and hear more of your market commentaries, because those are just fantastic stuff that I strongly urge people to check out on a regular basis. Tell them how they can do all that.
Thank you so much for saying that, Michael. I appreciate it. So the website is pentoport.com. You can email me at mpento@pentoport.com, and the phone number here for the office is 732-772-9500. I enjoy putting my commentaries out. You can subscribe to my podcast. You can order my book, The Coming Bond Market Collapse. And we won't bite here. Pick up the phone, call the office, and speak to me and learn how you can best make money when the wood is green and when it turns dark. Because, by the way, I'll tell you, what appears to be ostensibly a period of prosperity and global exuberance will not last. I can assure you of that, unfortunately.
Well put. Great stuff, Michael. Thanks so much. Safe travels. Enjoy your weekend, and we look forward to having you back on before long. Take care.
Thank you very much, Michael.
Well, that will wrap it up for this week. Thanks again to Michael Pento of Pento Portfolio Strategies. For more information, just visit pentoport.com. That's pentoport.com. You can sign up for his email list, listen to the midweek podcast, and get his fantastic market commentaries on a regular basis. Again, just go to pentoport.com. And don't forget to check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.